What if I told you that most home buyers willingly hand over hundreds of thousands in extra interest without ever realizing it? Today, we're breaking down the mortgage game. By the end, you'll know exactly how to play it differently. Chapter 1. What is a mortgage? Let's start with the basics. A mortgage is a loan, but it's unlike any other loan you'll ever take. When you borrow money to buy a home, you're entering into a 15 to 30-year financial relationship with a lender. And the terms of that relationship will shape your financial future for decades. Here's how it works. The bank lends you the purchase price of the home, minus your down payment. In return, you agree to pay that amount back, plus interest, in monthly installments. Simple enough, right? But here's what most people don't fully appreciate. In the early years of your mortgage, the vast majority of each payment goes to interest, not to building equity in your home. This is called amortization. On a 30-year, $400,000 mortgage at 7% interest, your first monthly payment is about $2,660. But only $327 of that reduces your actual loan balance. The other $2,333 goes straight to your lender. That's 88% to interest, 12% to you. In year one, you'll pay over $28,000 in interest, while paying down only about $4,000 of principal. The bank's math is extraordinary. Make sure you understand it before you sign. Chapter 2. Fixed versus adjustable rate mortgages. Now let's talk about the two main types of mortgages, fixed rate and adjustable rate. A fixed rate mortgage gives you the same interest rate for the life of the loan. If you lock in at 7%, you'll pay 7% in year 1 and year 29. The certainty is powerful. Your monthly payment never changes. You can budget decades ahead. And if rates rise, which they have done historically, you're protected. An adjustable rate mortgage, or ARM, works differently. You get an initial fixed period, usually 3, 5, or 7 years, often at a lower rate than a fixed mortgage. After that, your rate adjusts periodically based on a market index. Here's where it gets interesting. A 5/1 ARM means you're locked for 5 years, then adjusts annually. If you're planning to sell or refinance before that adjustment period hits, an ARM can save you thousands in interest up front. But if rates rise and you're still in the home, your payment can jump significantly. The ARM gamble works when rates fall or stay flat. It backfires when they climb. Understanding your timeline is the key to choosing wisely. Ask yourself, how long do I plan to stay in this home? That single question should drive your decision more than almost anything else. Chapter 3. The hidden costs nobody talks about. The purchase price of a home is just the beginning. What you actually pay each month and over time is a very different number. Let's walk through the full picture of homeownership costs. First, private mortgage insurance, or PMI. If you put less than 20% down, most lenders require PMI. This can add $100 to $300 or more to your monthly payment, and it protects the lender, not you. The good news? Once you reach 20% equity, you can typically request it be removed. Second, property taxes. Depending on where you live, this can range from under 1% to over 3% of your home's value annually. On a $400,000 home in a high-tax state, that's up to $12,000 a year, or $1,000 per month on top of your mortgage payment. Third, homeowners insurance, required by virtually every lender. Expect anywhere from $1,000 to $3,000 per year. Fourth, HOA fees. If you're buying in a planned community, condominium, or anywhere with shared amenities, homeowners association fees can add hundreds per month. Fifth, maintenance and repairs. The rule of thumb is 1% of your home's value per year. On a $400,000 home, that's $4,000 annually budgeted for the unexpected. The roof, the HVAC, the plumbing. When you add all of this together, the true cost of homeownership can easily be 40 to 60% higher than just your mortgage payment alone. Budget for the real number, not the advertised one. Chapter 4. When refinancing makes sense. Refinancing is the process of replacing your current mortgage with a new one, ideally with a lower interest rate or better terms. Done right, it can save you tens of thousands of dollars. Done wrong, it can cost you. Here's the fundamental question you need to answer. How long will you stay in this home? Let's say you refinance and pay $6,000 in closing costs to drop your rate from 7% to 5.5%. That drop saves you $350 per month. Divide the cost by the savings. 6,000 divided by 350 equals approximately 17 months. That's your break-even point. If you stay in the home longer than 17 months after refinancing, you come out ahead. But here's what most people overlook. When you refinance, you're often resetting your amortization clock. If you're 10 years into a 30-year mortgage and you refinance into another 30-year loan, you've added 10 years back onto your debt. You might be paying a lower monthly amount, but you're paying it for a decade longer. The solution? Consider refinancing into a shorter-term loan. Going from a 30-year to a 15-year mortgage typically means a lower interest rate, and you pay off the home in half the time. The monthly payment is higher, but the total interest paid is dramatically lower. Cash-out refinancing is another option. You borrow against your home's equity for renovations, debt consolidation, or investments. But tread carefully. You're turning equity into debt, and your home secures the loan. Know your numbers before you pull that trigger. Chapter 5. How to get the best rate. Your mortgage rate is not random. It's a function of several factors. Some you control, some you don't. Let's focus on what you can actually influence. Credit score is the single biggest lever. Borrowers with scores above 760 consistently get the best rates available. A 100-point difference in credit score can mean a 0.5% to a full percent difference in your rate. And on a $400,000 mortgage, that's the difference of tens of thousands of dollars in interest over 30 years. Loan-to-value ratio is next. The more equity you put in, the larger your down payment, the lower your rate. Lenders reward lower risk with better pricing. Loan type matters too. Conventional loans, FHA loans, VA loans for veterans, and USDA loans for rural buyers all carry different rate structures. VA loans in particular often offer some of the lowest rates available, with no down payment requirement. And then there's shopping. Most buyers contact one lender and accept whatever rate they're offered. That's a costly mistake. Studies show that getting just 2 to 3 mortgage quotes can save the average buyer over $1,000 in the first year alone, and much more over the life of the loan. Work with a licensed mortgage broker who can shop your application across multiple lenders simultaneously. That's exactly what the loan desk does, finding the best terms across a wide network so you don't have to negotiate alone. Here's what it all comes down to. A mortgage is probably the largest financial decision you'll make in your lifetime. Understanding how it truly works, the amortization math, the hidden costs, the refinancing calculus, the rate factors, puts you in control. Don't let your lender be the only one who understands the numbers. You should too. If you found this breakdown valuable, hit subscribe. We publish deep dives like this every week on mortgages, refinancing, real estate strategy, and everything the financial system hopes you won't learn. The Loan Desk. Knowledge is your best rate.